Hi guys. This video is the third in our series looking at banks and monetary policy, and in this video we're going to be looking at commercial and investment banks with a particular focus on commercial banks. We're going to be zooming in on why these banks are important and their roles in the economy, as well as some of the ways in which they operate. Before this video, make sure that you've looked at the previous two chunks, because in order to understand what's going on, we're going to need to understand how financial markets work in general, as well as what we looked at in the first chunk, introducing ourselves to money and where it comes from and how it works. Let's dive in by looking at commercial and investment banks as two separate institutions. We're going to spend most of our time looking at commercial banks, and that's a financial institution that aims to make profit by selling banking services to customers. And so we're basically thinking high street banks. We need to know about investment banks though, which are banks that don't directly interact with the general public but are involved in financial advisory services and more complex financial transactions. We're thinking really big scale, complicated transactions that don't have a direct impact to the normal activities of commercial banking. Commercial banks are sometimes known as retail or high street banks, and they're banks like RBC, Barclays, RBS that you'll see on the high street. They'll offer loans and savings services to members of the public, to consumers, and to firms. And they've got a number of different functions. They'll accept deposits having savings and checking accounts. They'll manage those accounts and transfers between them. They'll make loans. And often we'll find that they also provide financial advice. Now, we don't need to worry so much about investment banks, but we do need to know roughly what they are. They're also known as merchant banks. And big examples of banks that you will have heard of, like JP Morgan and Goldman Sachs, that really hit the news 12 or so years ago with the financial crisis. And so lots of media you might have seen about kind of banks and banking, things like the Wolf of Wall Street and The Big Short. These are the kinds of institutions that feature in those films. Normally, therefore, they're interacting with businesses and other financial institutions and governments, but not members of the public. In the UK, they're mostly located in the City of London, and their functions are a little bit different. They raise finance for firms by selling shares on the primary market, as we spoke about in the last video. They underwrite the issue of shares, which means that they offer services whereby they guarantee a minimum sale price to the firms for whom they're selling the shares, in order to add some insurance, which is a function that they do charge for. They offer trade in financial assets other than just on the money market, and again they do provide financial advice, but we're thinking to funds, pension funds, hedge funds, big firms, financial institutions, governments. Now, we don't need to worry too much about investment banks, but what we do need to think about is some of the issues that come from both of these banks operating under the same roof. Because lots of the banks that we'll meet do both commercial and investment banking. And why we need to think about that is because that link between commercial and investment banking leads to something called systemic risk. And that's the risk of breaking down in the entire financial system, caused by the interlinkages within the system, rather than just simply the failure of an individual bank. In other words, every financial institution bears some risk. There's always a risk of it failing. But if there's a risk that when one fails, it brings down the whole system, that's known as systemic risk. And it's massively increased when banks operate in both commercial and investment banking. In the video description, I put a link to an article on this because we need to know a little bit about this idea of systemic risk. It's an article talking about the 2008 financial crisis. Now, we just need to read a couple of paragraphs to get the answers to these questions. But here are 3 questions that you'll want to have a think about, as well as some key words. Leveraged, wholesale funding market, and subprime market are words that you might need to look up. I've got them here on the screen. Read the article and see if you can think of the answers or write down the answers to these 3 questions, and so that we have a think about both systemic risk and the importance of commercial and investment banks in the like of it. Pause this video and have a go at that task. Okay, so I hope you essentially got the gist. When banks both have commercial and investment elements, it means that they can kind of cross-subsidize each other and therefore end up being much more leveraged, which means they've got much more debt. And as a result, if there are issues, it's much harder for those banks to get out of them. The result of this was something called the Vickers Report in 2011, which we're going to look at a little bit more when we look at financial market regulation. Banks can now no longer have both commercial and investment banking under the same roof. They're now what's called ring-fenced. And again, we'll look at that more when we look at financial market regulation. Well, let's zoom in on commercial banks and have a look at how commercial banks work in a bit more detail. The thing that unnerves people about banking is that when we zoom into banks, we realise that actually the Bank of England doesn't create money. It's banks that create money. And let's see how that process works. We're going to make a few simplifying assumptions to see how the commercial banking system works. We're going to assume that in the economy there's only one bank, that it's only got two assets, cash, money, and advances, which are loans to customers. And there's a cash reserve ratio of 10%. That means if the bank lends out money, it has to keep, if the bank has deposits, it has to keep at least 10% of the value of the deposits in cash. And it'll become clear what that means in just a moment. Now, obviously, these are very restrictive assumptions, but we'll see that they paint a really useful picture, which we'll generalize in a moment. So here's the balance sheet of this bank. Balance sheets consist of the total assets and liabilities. Now, suppose a consumer deposits £1,000 in this bank. The bank gets an asset. It gets £1,000 in cash, and that is an asset because it can be used. But at the same time, it gets a liability because that £1,000 deposit is now money it owes to the consumer. If the consumer wants his or her £1,000 back, the bank has to give it. So that £1,000 generates both an asset and a liability. So why is a deposit a liability? What is the bank's current cash reserve? And what will the bank want to do? Just pause the video and have a think through those questions to just check we're on the right track. So why is a deposit a liability? Well, it's because if the consumer wants their money back out of the bank account, the bank has to pay them. So the deposit is money the bank owes. What is the bank's current cash reserve? Well, that refers to the cash it has with which it can pay deposits. So its current cash reserve is £1,000. What will the bank want to do? Well, maybe you figured this one out. The bank wants to lend some of that £1,000. And that's because it knows that on average, consumers aren't going to want all of their cash back all the time. Otherwise, why would they be in the bank? So the bank can safely lend out some of that cash to other people in order to earn profits on loans. At the moment, the bank isn't earning any money. It's got to lend out some money in order to generate interest, which the bank is profit. So suppose instead this bank lends £500. £500 is lent of that initial £1,000. Now let's think about that £500. That's money, because that's money that's gone into the pocket of a firm or a consumer. And it's actually going to be going back into the bank as a deposit at some point, but we'll talk about that in a moment. So when it lends £500 as an advance, that is money. But at the same time, that £1,000 deposit is also money, because the consumer can at any time access it. So what's happened to the money supply in this situation? Would you see that the money supply has gone up to £1,500? Because that initial £1,000 deposit is money, but so too is this £500 that's been lent. So here's the key idea. As long as people believe banks will honour their obligations, banks can increase the effective money supply. It's important that people believe that banks will honour their obligations, because people have to believe that those deposits are worth something. The consumer has to know that they can take out their money at any time. Otherwise, they're not going to view the deposit as worth £1,000 because they don't think the bank will honour them. But if people think, yeah, my money in the bank is safe, well, that money in bank accounts is money, but so too is the money that is lent out from that money. I hope that makes sense. It's a slightly tricky idea. If we get our heads around it, we'll really understand what's going on with the money supply. And a lot of economics textbooks aren't crystal clear on this. Let me reiterate once more. Here's the key idea. The money that's been deposited in the bank is money, but the money that's been lent out from that deposit is also money. So there is more money in circulation. The deposits are money, and so are the loans issued using that money. Now, when that money is lent out, the way banks lend out money, they don't just give you cash. They put it into a deposit. So when the bank lends out money, that money that's lent goes back in as a deposit, which then may be spent. The maximum amount this bank can lend is £9,000. And the reason for that is that it's got a cash reserve ratio of 10%. So for £10,000 of deposits, it's got to have at least £1,000 of cash. So the initial £1,000 of cash can be turned into £10,000 of deposits. Don't worry about the maths behind that, because there is a bit of a process that we're not talking about. But that's just the key idea. With the 10% ratio, that means we can end up having another 9,000 being created. So let's go through what was the initial narrow money supply. I'll leave you to think about these questions for just a moment. What was the final broad money supply? How much credit has the bank created? Let me pause the video, have a quick think. Okay, so in this scenario, the initial narrow money supply was that £1,000, but the final broad money supply is £10,000. What's happened here is that the bank has created £9,000 of credit. The process they've gone through, the £1,000 has been deposited, they've got £1,000 of cash. Now with that £1,000 of cash, they then lend some of it out. That lent money becomes deposits, because that's how loans work. The bank credits the borrower's account. And that deposit then becomes money that they can lend again, and so on and so forth until we hit this upper limit. The original £1,000 of cash could be turned into £9,000 of credit for a total £10,000 of broad money. Hopefully, guys, that is clear. It is a tricky idea. This process is called fractional reserve banking. And the idea is, because banks can lend money like this, they can effectively create an increase in the money supply. But the key idea is that it's just loans. It's not that they've actually kind of pulled money out of thin air. They've just lent money. And the reason there's more money is just because the money that consumers have deposited isn't actually there anymore. It's not just sitting in a safe house, it's being lent out. But if they want it back, they can take it because the bank has enough cash in reserve to meet those obligations. Now, this is a really bad model of banking, because what we've assumed here is that all money goes through this one bank. Now, in reality, that's not the case. But if you look at the whole banking system, this is going to be true. Even if the loans don't end up in the same bank's deposits, they end up in some banks' deposits. And therefore, this is a really good model of the whole banking system. The whole banking system has the ability to increase the amount of money in circulation. And that's why, if we looked in our one of our previous videos, we looked at the difference between narrow and broad money. This is why there's a difference. Because when there's one bank, because banks can turn cash into loans and thus increase the money supply. Complex idea. I hope you've got your head around it. If you haven't, look back through this and hopefully we'll get our heads around it. Remember the key idea? They're lending money that's been deposited. That's the most important idea. And the reason we get to this £10,000 figure from the £1,000 of cash is because they've got a 10% cash reserve ratio. And that means they're legally required to keep 10% of their total deposits as cash. Now, in reality, banks don't always lend up to that limit. In fact, not every country has a limit like that. In the United States, there is a reserve requirement, and that means the amount banks can lend depends upon the reserves they have. They can't have deposits that are too much bigger than the amount of cash they have. But in the UK, there isn't such a limit. And that's because banks rarely ever lend right up to this limit. In fact, the amount of credit they create, the amount of loans they lend out, leading to deposits being created, depend on a number of different other things. Liquidity is one issue. Banks need to hold the right amount of liquid assets, that's the cash, in order to pay back deposits. Now, if they hold more liquid assets, more cash, they're more likely to lend, because liquid assets, the cash, isn't really profitable. Because they're not lending it out, it's not generating any interest. So they want to lend out liquid assets. But they won't lend out too much because they want to be able to meet their deposit obligations. So if consumers do try and take out money, they've got enough on hand to pay them back. They're going to consider capital. If banks hold more capital, they're less likely to become insolvent, which means they're unable to meet their liabilities, their debts, if the value of those assets falls. Complex sentence. Don't worry too much about the detail of what it means. But capital refers to assets which have value. And if those assets fall in value, that might mean they end up in a situation of negative equity, where they can't pay back their liabilities. And that's called insolvency. And so they need to hold enough capital to minimize that risk. And more capital, therefore, means they're more likely to lend because they're happy generating more liabilities if they're in terms of deposits if they've got more capital. And in the UK, that's how banks are regulated, by a capital requirement. We've also got our cash reserve ratio, and in some countries, an externally imposed cash ratio, that's the ratio of cash to deposits, limits bank lending. Though that's only the case in some countries, it's not the case in this one, in the UK. Unfortunately, demand for loans is going to affect how much banks lend. If people don't want to borrow, then banks aren't going to be able to lend very much money. Good. Now, guys, this fractional reserve banking stuff is really one of the most complex parts of the course. If you're struggling, drop a comment below. It's a difficult section of the course, so go back and have a look through and see if you can get your head around why it is that banks can lend money, thus creating a money supply. So we've looked at how banks create money, one of the trickiest parts of this topic. Slightly easier, let's look at how banks, what more realistic banks have in their balance sheets. The picture we've painted, we drew some balance sheets, but we only had two different assets and liabilities. We looked at cash, deposits, and advances, or loans. But in reality, banks have a lot more on their balance sheets. So I'm going to run you through a few key terms, and this is partially just for interest. We don't necessarily need to know all of these definitions, but it'll really help you when you do look at the news and when you engage with economics beyond the course to understand what these are. So feel free to jump ahead through this part of the video, but if you're interested, here are a few key terms that describe what's going on in banks' balance sheets, and we do need to understand the structure of balance sheets. Okay, so assets and liabilities, here's a few. We've got bills, and bills are short-term loans, which banks might have. That would be an asset because it's something that the bank can own. They're basically lending money to either industry with commercial bills or the treasury, the government. Cash represents an asset, as do fixed assets. So their buildings are going to be their most illiquid asset, the buildings the bank owns. Banks have balances at the Bank of England as well, which is another asset. That is their reserves. They will lend out some money to other banks. This is something known as LIBOR. LIBOR stands for the London Interbank Operating Rate, and that determines the rate of interest at which banks can lend to other banks. And here's the key idea. Banks lend to other banks short term in order to meet their obligations. So if one bank suddenly had lots of consumers taking money out, it can, for a very short period of time, borrow from other banks. And that helps banks remain liquid and enables them to lend more because they know that they don't have to keep so much cash on hand because they can borrow money if they do have an issue. They'll also have financial investments like bonds that are a bit less liquid and some short-term borrowing. So that's a liability when banks borrow money short-term. That might be the opposite of LIBOR when the banks lend money out. Short-term borrowing, long-term borrowing, advances, so loans and mortgages to customers we've already met. Customers' deposits, remember that's a liability because customers might withdraw that money. Share capital refers to money saved in the bank from firms that has been raised from selling shares. Firms will also save their reserves, so their retained profit, and that's basically a fancy term for firms saving money. That'll be in the bank as well. And what I'd like you to have a go at doing, guys, is to sort those different things onto assets and liabilities. See if you can figure out which side of a balance sheet they go on. Pause the video, have a go at sorting them into assets and liabilities, and then I'll go through them in just a moment. Okay, so on assets, we've got our cash, balances at the Bank of England, money that's been lent to other banks, because remember that generates an income stream, commercial and treasury bills that have been lent to firms and the government, their financial investments, their advances, their loans out to consumers, and also their fixed assets. On the other hand, share capital, reserves from firm, remember that's firms' reserves saved at the bank, and deposits are all liabilities because they're all things where the firm or the consumer could withdraw that at any time. The short-term and long-term borrowing that the bank has done is also a liability. That's a debt they have that they're going to have to pay back. Okay. Lastly, guys, let's quickly look at the objectives of a commercial bank. So we've seen what commercial banks are. We've seen how they're able to generate income by lending money out from the deposits that are stored in them, thus effectively increasing the money supply. We've seen how their balance sheets are structured. But lastly, let's just think about their objectives. Now, in a nutshell, what do banks want to do? They're a firm. They want to generate profit. But we've just got to know a little bit more detail. Because in order to generate profit safely, they also require liquidity and security. Liquidity means having enough cash on hand that they can meet their deposit obligations. If they don't have enough cash on hand, the risk is a bank run. If consumers don't think that the bank is going to pay them back, what are they going to do? Well, they're going to take their money out before it all goes wrong. But the problem is if everybody tries to get their deposits back, there's no way the government will be able to pay everybody their money at once. The bank. The bank won't be able to pay everybody their money at once because most of that money has been lent out. So the whole banking system depends upon the fact that people don't always demand all their deposits all the time. So the bank is able to lend out most of those deposits, thus effectively increasing the money supply. But the problem with that is that if everybody does suddenly demand their money, the bank can't pay, they lose liquidity, and we've got a real problem. That's what a bank run is, when savers lose confidence in the bank and begin withdrawing money. So banks have to have enough liquidity that they can convince their savers that they are going to be able to pay their deposits back. They also require security, we spoke about this a moment ago, to avoid the risk of insolvency, where the bank can't pay back its debts because it doesn't have enough money, it doesn't have enough value in its capital. So if it doesn't have enough financial capital, it might not be able to pay back its debts. Its assets might lose. If its assets lose value, they can't fund their liabilities. And that's what happened with the subprime mortgage crisis in 2008. A little bit old school now, but it's good to be aware of it. Some of their financial assets, the debts they had out, failed. They couldn't be paid back, so the value of those assets dropped. And because the value of their financial assets dropped, banks didn't have the funds to meet their own debts, and so banks became insolvent. They couldn't pay back their debts. So in order to safely achieve profits, we've also got to be liquid and secure. And those are the three key things: profit, liquidity, security, that we saw we trade off when we looked at the financial markets in the last video, just the same. Banks have the same concerns as all financial investors. So just as there's a trade-off between security, how safe something is, how safe the value of it is, and profitability, there's also a trade-off between liquidity and profitability. So the most liquid assets, like cash, generate the least returns. Cash generates no returns. Nobody pays interest on cash just sitting in the bank's own reserves. They've got to do something with it for it to generate money. If it goes to the Bank of England, it earns a bit of money from the base rate of interest. They lend it to other banks, they can do that at a slightly higher rate of interest. The same with bills, investments, advances, and fixed assets. All of these are less liquid, progressively less liquid, but more profitable. Fixed assets, the physical buildings that the bank owns, are very profitable because they enable the bank to have branches and generate an income that way, but they're not very liquid at all. 2 questions to close. Why doesn't the bank just have profitable assets? Why doesn't it just have liquid assets? Once again, pause, think, and we'll discuss in a moment. So why not just profitable assets? Well, because they're not liquid. The most profitable assets are the ones that are the least liquid. And the problem with not having enough liquidity is that if there is an issue where lots of savers try and withdraw their deposits, the bank can't meet its obligations. We get a bank run and the bank collapses. Incidentally, a good example of that, if you want to look it up, is Northern Rock back in 2008. Why not just have liquid assets then? Well, liquid assets don't generate profit, and we want to generate profit. And that's why banks will keep enough cash to meet normal deposit withdrawals, but they'll also have lots of less liquid assets in order to generate a profit so they can pay interest. And guys, that in a nutshell is how the banking system works. Once again, this is quite a chunky video, so you might want to go back and have a look at some bits of it as we've gone through. Key ideas we've looked at are what the way the banks are structured, commercial investment banks, systemic risk. We've looked at how banks create money by lending out from their deposits. We looked at the structure of the balance sheets of banks. We've lastly finished by looking at the objectives of commercial banks.